Our base case, which I actually think is under-optimistic, that gets to 1.3 million by 2035, is based primarily on Bitcoin going from 9% as big as gold to 25% as big as gold. That's a really conservative assumption, right? If you think about Bitcoin's journey over the last 10 years, going from 0 to 9%, it's an infinite increase. If it only gets to a quarter as big as gold, you're talking about Bitcoin at $1.3 million. If it gets to as big as gold, you can multiply that by 4, and you're in the $7 million range. If you think it's going to be bigger than gold, you get into the $10 million range. It really doesn't take very extreme assumptions to get into millions of dollars of Bitcoin's value. The mistake I see people making all the time is assuming the gold market, which we proxy against, is fixed.
Bitcoin isn't aiming for Wall Street's respect anymore. It's coming for gold's throne. After years of being mocked as internet money and dismissed as a speculative toy, it's quietly morphing into a serious contender for the title of global store of value. The best part? It doesn't need hype to make headlines anymore. It just needs math. Because if Bitcoin captures even a fraction more of gold's market share, the price targets start sounding like science fiction, except they're not. Bitwise CIO, Matt Hougan, breaks it down in a way that stops you mid-scroll. His base case puts Bitcoin at $1.3 million by 2035, and he admits that might actually be too conservative. That number comes from Bitcoin simply growing to 25% of the size of gold. Not equal, not dominant, just a quarter of the way there. Full parity? That's $7 million. Go beyond that, and you're in $10 million territory. Suddenly, those wild price predictions don't seem so wild. They seem reasonable. The biggest mistake investors make is thinking the gold market is some hard ceiling. What if it's just the starting line? In a world sprinting toward digital value, Bitcoin isn't just keeping up. It might be lapping the competition. Let's hear more from Matt Hougan.
For those of you who are crypto native, long-term capital market assumptions are research reports that large Wall Street firms put out each year forecasting the 5 to 10-year returns of all major asset categories. JP Morgan puts them out, PIMCO puts them out, Vanguard puts them out. Everyone, I don't know what happened there, but they put them out as well. I think that was BlackRock. The core idea is this is how institutions allocate their portfolios. They look at these forecasts of long-term returns, and that's how they determine their strategic portfolios. How much stocks, bonds, private equity, venture capital, etc. And maybe the most important slide, the slide with the most alpha on my presentation today is this one, which is I've been at Bitwise since early 2018 talking to institutional investors, and the number of people who asked me for long-term capital market assumptions was 0, 0, 0, 0, 0, and then in 2024, 0, and last year, this year, 12 major institutions asked me for these. These are national account platforms with trillions of dollars of assets. These are financial advisor groups with thousands of advisors. I had 12 people independently ask me, are you going to put out a long-term capital markets assumption piece on Bitcoin? And when they ask, we deliver, so we did. This is what the findings are. We'll get to all the reasons for this. You can take pictures, I love it. This is what we've been telling these 12 institutions to expect, and I'm going to walk through how we get here. Now, capital market assumption pieces follow this familiar format. You have to introduce the big picture, and then you have to draw down to how that drives the returns of your asset. This is all basic to you, but I think maybe it's good during these grindy moments where Bitcoin has been going sideways for a year to peel back and think of some of the big picture elements that we should all incorporate into our long-term projections. So here's one. We have 3 core theses that drive this long-term view of Bitcoin. The first is that there's rising concern about the outlook for fiat currencies. That's not a radical statement in this room, but in Wall Street, it's a bit more radical. We usually start with something like this. This is a slide. It's up only. Crypto should love this slide. But this is a slide of the U.S. debt, right? It's incredible. Half of all U.S. debt has accumulated in the last 10 years. Interest payments are almost $1 trillion a year. The ecosystem we're driving into with our long-term capital market assumptions is one where the debt is up and to the right and just going forward. And what do you do in this environment? Well, this is what Ray Dalio says. When countries have too much debt, what they do is they print their way out of it. He recommended 15% gold or Bitcoin. I was tweeting earlier today, Harvard is worried about this. They put on a debasement trade this year. They bought $500 million of Bitcoin. An interesting fact, they bought $250 million of gold. Really remarkable that Harvard 2-to-1 Bitcoin versus gold as they put on their debasement trade. This is maybe another one of the alpha slides in this presentation. This is something crypto doesn't talk about a lot. This is the market cap of gold. This debasement trade has been going on for a long time. Earlier today, we heard Hong from my company talking about the launch of gold ETFs in 2004. When gold ETFs launched, gold was a $2.5 trillion asset. When Bitcoin ETFs launched, Bitcoin was a $2 trillion asset. Gold's now $27 trillion, it's 10x. A lot of people ask me, what will it take for Bitcoin to 10x? All it takes is for Bitcoin to stay at the same proportion of the gold market it is today, about 8% of the gold market, and for the gold market to continue to grow the way it's been growing for the last 20 years. Right? Gold went from 2.5 to 25 just through the passage of time and the growth of this debasement trade. Bitcoin will do that and then some. A lot of people, when I talk to institutions, say, well, Bitcoin isn't gold, it's way too volatile. I love to show them this chart. This chart shows that rampant volatility, but of course, this is not a chart of Bitcoin, that's actually a chart of gold. We have this false assumption that gold is this perfect, even, easy hedge. It's not. It's been very volatile since we went off the gold standard in 1971 with huge pullbacks. In fact, in that first rip in the 1970s and then 80s, gold moved on average 3% or more a day every 4 or 5 days. It was hugely volatile. Our view at Bitwise, I don't need to convince this room, is that Bitcoin is better than gold for all these reasons. And so thesis one is long-term. We believe Bitcoin will be more valuable than gold. But our price target of 1.3 million by 2035 is not predicated on it getting all the way there. All right, let's talk about the other big thesis, second big driver, dollar dominance is shrinking. Right? These are just facts. This is a look at the U.S. share of GDP and the U.S. share of global foreign reserves. They are down only. So debt is up only. U.S. share of global reserves is down only. The reason for this, or the primary driver, is that countries are rotating into non-currency-based investments. This is the flows by sovereigns into gold. If you wonder why gold has been ripping and is north of $4,000 on its way probably to $10,000, it's that central banks ramped up their purchases after the U.S. seized Russia's assets in the wake of the Ukraine war, now buying 1,000 tons a year. And that's going to repeat this year as well. The growing number of countries are owning Bitcoin. We think this is up and to the right. We do consultations with a number of countries at Bitwise, and we are not the largest asset manager in the world. If we're doing them, others are doing them. So rising concern about the value of fiat currencies, rising interest from countries in the Bitcoin and non-currency-based markets. What's the third thesis? We think the pro-crypto regulatory shift appears to be permanent. This is a US-based view, but here in the UAE, you can feel it as well in the organization of the regulatory structure, which appears to be clearer and more consistent. I love putting up this slide of our chairman of the SEC, who's announcing Project Crypto. It's hard to imagine that the chairman of the SEC is more bullish on crypto maybe than I am. He was on Fox Business News yesterday saying all US stocks will be tokenized in a couple of years. That's a $68 trillion market being tokenized. He's launching things called Project Crypto. It's just remarkable, the regulatory change. We've dropped all the lawsuits against every major crypto company. We have acts moving through Congress. It's a remarkable thing. So what's the macro setup? Before we get into the Bitcoin specific setup, we think there's rising concern about the outlook for fiat currencies. We think dollar dominance is shrinking, and we think the pro-regulatory landscape is moving in a positive direction that is being sort of put in amber. All right, so where does that lead us to Bitcoin projections? This is what people want to really see. First, we'll start with returns. The three things that institutions care about are returns, correlation, and volatility. And I want to tackle each one. Let's talk about returns. I'm the CIO of a $15 billion asset manager, so I use a lot of complex math. My view is that the secret to valuing Bitcoin is by looking at supply and demand. I know that's complex, but I have even more secret. Rising demand plus fixed supply equals higher prices. I find it hard that people argue with this. I think it's just Fact. So here is our valuation model for Bitcoin that we've been sharing. I'll get out of the way since people are taking pictures. But there's one thing on here that I want to emphasize. What we've done here is we look at all the markets we think Bitcoin could address. Those are listed on the left. We look at the size of the markets, and then we take the historical CAGR of those markets and project them into the future. So you can see the size of the markets. Our base case, which I actually think is under-optimistic, that gets to 1.3 million by 2035, is based primarily on Bitcoin going from 9% as big as gold to 25% as big as gold.
Bitcoin is crashing Wall Street's most exclusive party, and it's no longer being shown the door. For the first time, major institutions are slotting Bitcoin into long-term portfolio models alongside stocks and bonds. Behind the scenes, fears of fiat debasement, ballooning U.S. debt, and the shrinking dollar's dominance are forcing capital to rethink its safe haven choices. Bitcoin's case isn't built on hype anymore. It's math, momentum, and macro pressure. And if the projections hold, seven-figure Bitcoin may be closer than most think. According to Matt Hougan, Bitcoin isn't just being noticed by Wall Street. It's being modeled, measured, and taken seriously. Institutional portfolios are now slotting it alongside stocks and bonds, with projections showing a potential 28% annual return through 2035. Even more impressive? It maintains low correlation with traditional assets and steadily declining volatility. The case isn't built on hype, but hard numbers. In a landscape craving yield and diversification, Bitcoin is starting to look less like a gamble and more like the sharpest play on the board.
Our model, just to put it in context, is not really that optimistic. We added some additional models here. They all have different time horizons, 2028, 2033, etc. But what you'll see is that almost everyone coalesces around this north of $1 million. And the reason for that, again, is that the assumptions to get there are actually relatively modest. The store value market continues to grow, not faster, which I think it will, but you project it just continues to grow as it's been growing. And then Bitcoin gets incrementally more share, not huge amount, not matching gold. Again, we're trying to be conservative because we're talking to skeptical institutions, and you end up at 1.3 million. Again, I think that's really conservative. Let's talk about correlations. This is the other big one. In fact, often institutions are more interested in this than they are in returns. And I think the quality of information in this space is worse than in anywhere else in crypto. All right, first of all, everyone says Bitcoin's highly correlated to stocks. That's really just not true if you look at the data. If you look at, I think this is 30-day correlations over the last 10 years, its correlation to equity is about 0.2. For people who aren't familiar with correlations, the way you think of them is 0 to 0.5 is a low correlation. In other words, they don't move together. 0.5 to 0.75 is a medium correlation. 0.75 and above is a high correlation. So 0.21 is really low, right? It probably means that Bitcoin's price is more correlated with the price of like avocados than it is of stocks over these 10 years. It's a very low correlation. All right, what will it be in the future? Well, let's look at it historically. This is that chart every day. I think this is 90-day correlations. Yeah, 90-day rolling correlations since Bitcoin started trading in 2010. So no data mining here. This is every single piece of data. What you can see is there's basically never been a time when it's been above 0.5. That means there's never been a time where it's not low correlated to stocks on a 90-day rolling basis, except for a tiny window after COVID where it peaked into moderate correlation. That was when we responded to COVID with so much stimulus that the correlation of everything went up. Bitcoin went up too, but only to about 0.6, and it's come back down. It also has no correlation to bonds and commodities. Remember, institutions use multiple assets, so the correlation to stock is what we talk about in the media. Correlation to bonds is 0. Correlation to other commodities is very low. Why? There are two reasons. These are obvious. I don't know why people are surprised by that. One is Bitcoin is having a one-time asymmetric inflow. What do I mean by that? Institutions are going from 0 to not 0. And so that flow is all one-directional. Whereas stocks and bonds, you have flows in and out. So you have a one-time flow versus flows in and out. And the second is that Bitcoin is just driven by different things than stocks and bonds. It's driven by regulatory developments. It's driven by ETF launches. It's driven by fiat debasement. These are different things than what drives the price of Ford. So why does the media say it's highly correlated? They say it's highly correlated because of this. On days where the US equity market goes down, Bitcoin goes down too. That's just true. And so the reason you get this not that it's correlated story is on the days that the media writes that story are the days where the stock market goes down 3%. And sure enough, on those days, Bitcoin goes down too. But if you span out for a meaningful period, if you look a year hence, if you took every minus 2% day on the stock market and invested in Bitcoin, your 1 year return would be over 200%. So it's just not long-term correlated. The correlation has increased since 2020. I think the reason for that is that fiat involvement and money printing became a bigger deal, but it's still pretty low. So where do we end up? We think the correlation will be higher than it's been over the past 10 years because we think central banks and fiat money is playing a bigger role driving all equities, but we still think they'll be low, about 0.36 versus stocks. All right, volatility, and then I'll sum this up and talk about where this all fits in portfolios. The volatility of Bitcoin has been going one way down. We've seen a lot of up-only charts. Volatility is a one-way down chart. This is 30-day rolling volatility since 2012. You can see it's just been falling down. So what will happen? This is a chart of gold, and I think it's really telling. This is a chart of gold's volatility. Everyone talks about gold like it's a 5,000-year-old asset. It's like a 55-year-old asset. You really can't talk about gold's price before the US went off the gold standard because it was just flat. So if we look roughly after we went off the gold standard, you can see that what happened is gold's volatility fell for about 20 years. Why did it fall for about 20 years? It fell because the world was skeptical of what gold would be, and it learned it had a place in the world as a store of value asset. And as the world digested it, its volatility fell and fell and fell. But then it sort of leveled off. Why did it level off? Because it didn't have any more risks to be removed from the market. I think crypto is doing something similar to that. We are removing huge risks from the Bitcoin market. We've removed regulatory risk, technical risk, adoption risk, liquidity risk. We have derivatives now. The volatility has been falling. We project that eventually it will actually level off. We still think it has a little bit further to fall, but we think eventually it will level off. So our prediction is that the volatility will continue to fall, but at about half the rate that it's fallen for the last 12 years. And that leads us to a vol of about 32.9. That statistic won't mean much now, but it will mean a lot in 2 more slides. Okay, so what does this sum up to? The way these institutions think about building portfolios is that they look at the long-term capital assumptions for all different asset classes. And so I've done that for you here. The way we did this is we took our long-term capital market assumptions for Bitcoin, because as far as I know, we're the only people who have put them out. And then we averaged the long-term capital market assumptions between JP Morgan, PIMCO, BlackRock, and Vanguard. We could have chosen other asset managers or other institutions, but once you get 4, you're close enough. This is what Wall Street thinks these different markets will return. And I would look at it closely. We think with our relatively conservative assumptions, remember our assumptions only are that Bitcoin will take 25% of the store of value market in the next decade, up from 9 today. We think Bitcoin will have a 28% return. That compares to the average Wall Street assumption of stocks at 6, the average Wall Street assumption of bonds at 5, and nothing else except for private equity getting above these double digits. If you wonder why private equity is so popular on Wall Street right now, it is the only place that Wall Street is projecting double-digit returns, except for Bitcoin, I think, will triple those returns. You can look at the volatility, and to be sure, we project Bitcoin's volatility to be higher than these other asset classes. I think anyone who tells you that that's not true is probably lying to you. But we don't think it's going to be that much higher. In fact, look particularly at private equity. You're talking about 10% returns, 26% vol. Bitcoin's 28% turns, and just a little bit more vol.
The final Fed rate cut of the year could be the spark Bitcoin has been waiting for. With expectations soaring and market odds putting a 0.25% cut at near certainty, the setup heading into 2026 looks explosive. Lower interest rates reduce the appeal of safe haven bonds and push investors to seek returns elsewhere. That's where Bitcoin steps in. According to analysts, this policy shift could propel Bitcoin to $220,000 within the next year. And this time, it's not hype driving the momentum. It's math, macro pressure, and monetary policy. This outlook aligns perfectly with what Matt Hougan has been telling institutional investors. His valuation model doesn't require crazy assumptions or moonshot scenarios. A modest increase in Bitcoin's share of the store of value market gets us to $1.3 million by 2035. That's not a fantasy. That's a base case. More institutions are building Bitcoin into their capital market assumptions. ETFs are seeing billions in inflows, and the volatility that once scared off Wall Street is steadily trending downward. What's happening now is bigger than a price spike. It's a structural shift. Bitcoin is maturing into a globally recognized asset class, one that moves with policy and responds to macro forces. As the Fed pivots and global liquidity improves, Bitcoin isn't just reacting, it's leading. The silent accumulation phase may be over. With rate cuts, institutional flows, and a shrinking pool of alternatives, Bitcoin's next leg up could define a new era of finance. And this time, the suits are already watching. As we wrap up, do you think Bitcoin will ever surpass gold as the dominant store of value? Let us know your thoughts in the comments below. Share this video and hit the like button. Thanks for watching, and don't forget to subscribe.